Please stand by. We're about to begin. Good day and welcome to this SOFTRAX Executive Webcast. Today's call is being recorded, and all lines are in a listen-only mode for the duration of today's call. And now, for opening remarks and introductions, I would like to turn the call over to Robert O'Connor, President and CEO of SOFTRAX. Please go ahead, sir.
Thank you, Matt. I am Bob O'Connor, the CEO of SOFTRAX, and we are a leading provider of revenue management solutions to hundreds of companies, many of whom join us on the call today. So welcome to all of you. We have several hundred registrants for this webcast, which indicates how much executives want to hear about today's topics from our two distinguished speakers from Software Equity Group, Ken Bender and Alan Sanzori. Ken will share his presentation on mid-year reality check for software M&A, and both Ken and Alan will be available for questions. Our audience consists of CEOs, CFOs, venture capitalists, board members, VPs, accountants, and other corporate and financial professionals. Let me just take a look at the agenda here for you. As I said, Ken Bender will be joining us to make a presentation. I will spend some time on SOFTRAX revenue management, and then Ken will present a very insightful and unique presentation talking about trends, market drivers, talking about the unique things that are happening in the marketplace, talking about valuations, which everyone always likes to hear about, and then also talking about software as a service and spending some time on that, and then also what to expect in the second half of the year. For those of you who are familiar with our format, we save the last 10 or 15 minutes towards the top of the hour for your questions. It is a very important element of our webcast. And to do that, the way you do that is you do that online. And if you look for the Ask a Question feature located on your console now, you can click on that button and type a question, and I will be reading the questions to myself throughout Ken's presentation, and then I will address them with Ken and Alan at the, as I said, in the last 10 or 15 minutes. The most commonly asked question that we get is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for that. If you see on the screen here, you will be asked for a feedback questionnaire. At the end of the webcast, your browser will be redirected to an online survey page. We read these carefully. We arrange our webcasts around your feedback. And once you provide that feedback to us, you get a copy of the slides. You'll also get the executive summary of Software Equities Group's 2006 Industry Equity Report, and from that you can also get the entire report because there's a link for that. So again, that's how you ask questions, and that's how you get copies of the slides. I'm just going to spend a few minutes on revenue management and the role that we see that revenue management plays in the M&A environment today. By way of introduction, our company provides revenue management software, and our customers manage billions of dollars through the use of our products. And throughout the U.S. and world, we have hundreds of customers in several different industries using our products, our software products, to manage their revenue, their billing, their revenue recognition, reporting, and forecasting. And as you may know, SOFTRAX started by serving exclusively software companies, and we are the clear leader in that particular industry. And as you can see, we have grown to address the complex revenue needs of many different industries. And having accurate and dependable revenue and revenue systems play a major role in M&A transaction, as revenue accuracy is a major issue with respect to valuation. And Sarbanes-Oxley has dramatically increased the risk of buyers and sellers for buyers who inherit the current and future revenue streams of the acquired companies and are concerned about the accuracy of that revenue. And the risk is higher for sellers as well, who need to understand the requirements and the revenue requirements that the buying companies adhere to. And certainly many of our customers are on acquisition sprees. Many of our customers are being purchased, and many of the leading software consolidators in the industry are our customers. Here's a quote from one of them when one customer recently bought another customer. And ideally, again, our revenue management software can ease the M&A process, as is noted here by former Interwoven CFO, to look at all current and future revenue streams as well as deferred revenue, make that a quick and smooth process to mitigate the risk of write-downs and deferred revenue, all of that is music to our ears when our customers are buying other customers. Speaking of Sarbanes-Oxley, here's a recent survey. In your opinion, for what areas is it most difficult to establish internal controls? And not surprisingly, number one, revenue recognition. Number two, contract administration and management. Two areas where we focus a great deal of our applications and the desire to solve customer problems. And CFOs of public and private software and technology companies do not lack for any challenges in today's environment. They have many operational challenges with the business model, the recurring model, whether it's subscriptions or renewals or complex maintenance arrangements or licenses. They have issues certainly around compliance in today's environment, whether it's Sarbanes-Oxley or the constantly evolving revenue recognition issues. And lastly, they have reporting, visibility, and transparency issues, not only from a reporting perspective, but from a forecasting and dealing with their investors. And our applications align very closely with these challenges and provide the following value propositions. Our billing and operational applications are meant to improve operational efficiencies and help our customers increase their revenue. Our revenue recognition applications allow for compliance not only of revenue but expense accounting in today's regulatory environment. And our business intelligence applications allow for a great deal of strategic benefit in terms of analyzing business performance as well as visibility into future performance. And our product lines align very closely with these value propositions. Our billing and operations applications handle things like complicated contract management, billing, contract renewals, subscription arrangements. Our very deep and unparalleled in the industry revenue accounting applications allow for compliance along all the issues that software and technology companies have to deal with. And our business intelligence applications provide the visibility and strategic analysis of the business. And our customers license these individually or all suites together, depending upon their needs. And our applications are complemented by other applications for services organizations and financial applications and so forth. We recently completed a survey that we're delighted to hear of the value that they're delivering to our customers. All our customers answered that they have a great deal of improved compliance with revenue recognition issues in Sarbanes-Oxley, a 50% efficiency rating improvement along the lines for things of contract management, renewals, reporting of revenue, billing, and deferred revenue, and improved customer relationships with respect to billing and accuracy of information. So our mission is to help customers increase their revenue, reduce their costs for operational efficiencies, and meet the ever-growing compliance issues that they are faced with in today's environment. So I'd like to introduce our featured speakers for today. Ken Bender is the Managing Director of Software Equity Group, a firm that he founded in 1992 and has become one of the nation's premier mergers and acquisition advisory firms. They serve privately held software companies, e-businesses, and IT services providers, as well as representing an array of public companies and private equity firms who are seeking strategic acquisitions. Ken has a lot of operating experience before founding this firm as a VP of MicroAge, a Fortune 500 systems integrator, and the president and CEO of Access Solutions. He's a corporate and computer lawyer by training. We won't hold that against him. And a member of several bars in Arizona and New York, and a frequent speaker in many software industry conferences, and widely quoted due to the expertise of himself and his firm. And he's joined by one of his partners, Alan Senzori. Alan joined the firm in 2001 as VP and one of the firm's rising stars, and brings many years of experience in business, engineering, and software investment banking. He conceived of, designed, and authored the annual Software Industry Equity Report and quarterly reports. About 4,000 people read those now, and we'll be offering that, as I said, to those people who fulfill the requirement on the customer feedback form. So, and Al will be available for questions. So I'd like to turn it over to Ken for the presentation.
Thanks very much, Bob. It's really our pleasure to participate in the web conference today, and we're appreciative of our partnership with SOFTRAX that enables us to bring to your audience and ours I think, some timely and important information to the software industry, particularly as it applies to the equity markets and software mergers and acquisitions. We're going to give you just a very brief background on our firm for those of you who are not familiar with us. I think we're pretty well known in the industry at this point as an investment bank and M&A advisory. As Bob said, we're 15 years old. We've actually, since our inception, guided and mentored and represented now some 1,000 private and public software companies on 5 continents. Our reports are actually now read in 26 countries by more than 10,000 public software company executives, VCs, private equity investors, many of our competitors, and a lot of service professionals that service the software industry. We've got our share of tombstones. Many of these, fortunately, are in the last 3 months. It's been the most active year by far for Software Equity Group. It's probably indicative of the industry, as you'll see by the numbers in a few minutes. What we've learned in these transactions and in speaking with scores of public software company CEOs and private equity investors in the course of representing our clients is that though the market is very active and is really performing now, it is not irrational. And that's very, very important. This is not the bubble days. These are a different kind of M&A environment. I want to start with an overview, and it's really important because this slide really drives a lot of what's happening in the marketplace. And all you're seeing here is relative performance of NASDAQ, the S&P 500, the Dow Jones, and our Software Equity Group software index, which we expanded in January of this year. This is our tracking index for the industry, which now consists of 265 software companies in 19 different software product categories. And our reports detail this, and you'll see some of that performance analysis in an upcoming slide. But you'll see here that the SEG software index and the NASDAQ have trailed the Dow and the S&P 500. Matter of fact, the SEG software index, which is really representative of the software sector, public software company performance, is quite a bit below what you'll see in the Dow and in the S&P. But what does that mean? It means that public software companies are under pressure to perform better. Perform better we'll define in a minute, but it really consists of revenue growth and profitability, net income growth. And to do that, they are, with increasing frequency, and this is a trend over the last 3 years, turning to what they believe to be astute, well thought out, value-driven, but when necessary, they'll pay the required price to acquire strategic plug-ins and tuck-ins and platform companies in order to grow that revenue, grow that profitability, and attract greater investor confidence. This slide, which we're not going to get into in too much detail because it's filled with detail, and I hope you'll spend some time with it later on, breaks down for Q1 and Q2 of this year, both the revenue growth year over year by quarter and earnings growth year over year by quarter, and the current valuations at the end of the first quarter and the end of the second quarter. Our tracking index breaks companies into infrastructure software companies and application software companies, and you can see the categories, how we've categorized them. The median trailing 12-month revenue for our index increased 12.5% quarter over quarter in Q2. That's good news. That means that these companies are growing their revenue, albeit some of it through organically and some of it through acquisition. The median trailing 12-month earnings for the SEG software index grew 8.7% in 2Q06 over a year ago. And on a quarter-by-quarter basis, median public software company valuations based on an enterprise value to revenue fell from 2.2 to 2.1 in the second quarter, but it's remaining pretty stable. Just want to look briefly at a couple of interesting categories here. You'll see that e-commerce enablement software, that's an infrastructure category that has smaller companies like Selectica, which is which is applications to sell goods over the web, and Art Technology Group and VeriSign, there's been very substantial growth in revenue and earnings. You're looking at earnings growth of 87.6%, the prior quarter 94%. It's a hot category, and the valuations on an enterprise value basis to revenue are still relatively low, and so some investors may see that as an investment opportunity. There are others who believe that it's not stable, and the future will tell. You've got categories like CRM, customer relationship management, which has really trailed most other categories for the last few years, with Siebel being indicative of the troubles that CRM has confronted. Now at a 2.4 enterprise value to revenue valuation, but you'll see in the right-hand side that there's some real growth. Finally, once again, the CRM arena is growing and profitable, although the valuations are still fairly modest in comparison to other sectors. And this is probably attributable to the fact that the delivery model of CRM has increasingly changed so that it's deployed less expensively as a SaaS model, and we're going to be talking to that in a minute as well. The last one on this slide I want to just point out is healthcare, which is about 5th from the bottom. You'll see a 2.6 trailing on a trailing 12-month enterprise value to revenue valuation there. You'll see that there is very substantial earnings growth and almost 20% revenue growth. We're going to talk about verticals a little bit later on, but I'll presage it by saying that vertical software company, public software company performance, and M&A multiples are, in our experience, at an all-time high, equivalent to horizontal technology software companies. We always believe that we've always talked about the downstream effect of IT spending on public software company performance, and also on the downstream effect on software M&A. So for us, IT capital spending is a key barometer, and we track about 6 different spending surveys. The one we like and continue to like is the Goldman Sachs IT spending survey. When we go back, it seems to be very, very accurate. You may remember from our talk 6 months ago that we ended the year with about a 2.6 to 3% spending increase in IT capital spending for hardware and software. The projections for this year are 5 to 7%. We believe it'll be on the high end of that range, and that bodes very, very well for software companies. And we expect that those revenue numbers that you looked at in an earlier slide, the revenue performance will continue to grow based on the spending survey. What's really interesting here is that these are prioritized top-down in terms of what the CIOs believed were their top priorities. Unsurprisingly, security remains a top priority. Goldman Sachs, and we concur completely, projects a 12% spending increase among enterprises for security IT spending. Much of it will go to identity and access management and intrusion detection prevention on both the network perimeter level and on the PC level, with web filtering, which was really hot 3 years ago, taking a lower position on the IT spending priority list. Also interesting here, if you look at thin client computing, which is the next to last, and you look at managed services, which is about in the middle, that's SaaS, that's software as a service, and as far as the CIOs of the many companies that Goldman Sachs interviewed, that is not a major spending priority. But we're going to spend some more time on SaaS and give you what I think are some pretty good prognostications about how that's going to change. So let's look briefly, as long as we're looking at software equity in all regards, at the IPO market. The bottom line is that investors and owners have no viable near-term path to liquidity in the current market. It's not a good situation, and we don't see that changing for the remainder of this year, and frankly for the first quarter of next year. Just to pick out a couple of these deals, Corel had a tough time getting investors excited. Of course, it's had a long and difficult history. During the IPO process, it lowered its price range to 16 from 18. It had an initial range of 18 to 20. It raised $80 million in working capital, paid off its investors $24 million. The Vector Capital Group, which took Corel private in 2003 at a value of $97.6 million, retained 72% of its investment. But you can see that Corel is off almost 41% from its late April IPO. Another one I want to take a quick look at is Omniture, a web analytics company, which more than doubled its revenue for the 3 years in a row. And in fourth year, this year, it's on track to do that again. Revenue in this quarter rose to 16.4 from 8 million. You can see it's still a very small company, but the company sustained huge losses. I think it's accumulated to about 35 million. It's a 10-year-old web analytics vendor, and it faces some tough challenges from Web Trends and Website Story and I guess Google Analytics as well. So if that's the IPO, not very encouraging for the private equity investors who have taken public companies private and now are waiting to take them public again, and particularly for the VCs who've put in an awful lot of money into portfolio companies preparing to take them public. If you look at the pipeline for 2006, it's not a very strong pipeline. These are relatively very small companies and relatively very small offering amounts. If you run down this trend, if you run down the list down this list of companies that have filed their S1s, Commvault is in data migration and backup. Debt Resolve is in it's a hosted provider of debt collection. Double Take is in storage management. Histopia is in web services. Local Matters are in converts Yellow Pages to web-based directories. ME Decision is physician practice management. Mitel, which is the only real interesting one there from a size standpoint, is in messaging and communications. But essentially, take a look on the right-hand column. Your IPO pipeline, which is not doing a whole lot to engender investor enthusiasm, 5 out of the 9 companies listed here are losing money. And in this era of emphasis on both top-line growth and bottom-line growth, and frankly, this is one of the first times we've seen this in a lot of years, where those companies that are being well received by the street, that are being touted by analysts in the software sector, are companies that have got to be demonstrating both top-line growth, including license revenue growth, new license revenue growth, and increasing profitability, real profitability that's growing.
And Ken, if I could just interrupt for a minute, I want to remind the audience that I have already given instructions on how you'll get slides, and I'll do that again at the end of this presentation, so you will be able to get slides. I want to remind people if they want to ask any questions to click on the question box, and I'll be reading them as I am now. And one of them, Ken, while we're at it, is you've talked about public valuations and public multiples. Will you spend any time on private multiples during this presentation?
Coming right up.
There you go.
So we will get to valuations with some granularity as well, because we've long maintained that anyone who looks at the median software industry multiple by quarter, which is what you find mostly published, is going to be very, very disappointed or surprised when it comes their turn to get a company-specific valuation. Just taking a quick look at VC capital, across all industry sectors, VC investments in Q2 was the greatest dollar amount since the same quarter 4 years ago. $1.3 billion went into 231 software deals. That's 20% of total VC dollars. Software remains the most active industry sector. But most of it went into expansion stage companies. Although you do see this blip in startup and seed companies, and it has improved, at least from a percentage standpoint, But relatively speaking, we're still talking about a very small piece of the pie in terms of actual dollars invested. VCs are willing to take a bit more chance, and we're seeing that, but not as much as some would believe, and they're still hedging their bet and playing it conservatively by funding expansion stage companies, which is better than late stage companies, which we were seeing in 2003 and 2004, but still does not bode well for the startup and early stage software company. Now to the grist of our presentation on software M&A. It remains at high levels. In the first half of 2006, there were an absence of mega deals like the SunGard transaction a year ago, but you're looking at a $12.2 billion spent in Q2, a $13 billion spent in Q1, and you'll see some projections later on, but I'll give you an early indication. We think that Q3 and Q4, that number is going to increase. You'll see what we're predicting in a minute and why. But I think a forerunner of that is yesterday's $1.3 billion acquisition of Internet Security Systems by IBM. That's going to pump up Q3, and I think you're going to see other mega transactions in the next 2 quarters. On a deal volume basis, we remain in Q2 active, quite active. If you look at the last 2 quarters, you're looking at an aggregate of 857 deals, and this really bodes well for the next half of the year as well. It's important to understand who's coming to the table, and what we're seeing here is a significant number of private buyers, as we have seen in the past few years. These are primarily venture-backed private software companies seeking to fill gaps and do tuck-in acquisitions and grow their revenue. We're also seeing a significant number of direct investments by VCs and private equity firms to grow their platform companies. 2 examples. In the last, the last 4 or 5 weeks, we've sold 2 of our sell-side clients, Wellcome and CS Solutions, both of which are in the very advanced project management, earned value management space, to Deltek, which was a public company taken private by New Mountain Capital. But you've got lots of other examples there. Francisco Partners merged Attachmate and WRQ, and then bought this quarter NetIQ. Battery Ventures, which some time ago Made to Manage Private, acquired Onyx Software. Infor, which is owned by Golden Gate Capital, acquired SSA and Mapix and DataStream. So the private equity firm and private software company continue to represent just about a third of the buyers out there. And from a how do I sell my company and what's the strategy, the fact that you may have strategic buyers out there and very active private buyers out there means that you're going to have to be very astute in how a privately held company is taken out and presented to these very different kinds of buyers. Here's the data on some of the valuation that you wanted. The vast majority of these are privately held companies. And you can see that from the median valuation standpoint, it declined from 2.8 to 2.3 in the last quarter. Doesn't trouble us at all. It's a blip. You'll see blips. That's why we presented these historically. There were blips all along the way. In Q3 of last year, you went from 2.9 to 1.7 and right back to 2.8. We have every belief and every reason to believe that you'll be back to 2.8 or something very close to that in Q3. Certainly from the transactions we're doing at a record pace and the transactions that we're logging. And we believe we log and analyze every publicly reported software transaction in North America and most in Europe as well. But please be aware that if you take that median valuation and you're a software entrepreneur on the other end of this line and you multiply your trailing 12-month revenue by 2.3 or 2.8, that's fraught with peril. Don't be deceived by median valuations is the message of this slide. So very quickly, because I could spend an hour on this slide, and it's real important, and I would commend it to you for reading after this. 21% of all of the transactions that you saw on the preceding slide, the 820-something 7 transactions, 21% were public sellers, 79% were private sellers. The median multiple for the public sellers was 1.9 based on an equity value, but for private sellers, 3.0. We can spend a lot of time analyzing that, but can't today. But we can take some questions on it later on. The next item down, vertical sellers. We've never seen something like this. When the horizontals and the infrastructure technologies and the middleware and the likes went to 3 and 3.5, verticals just stuck to the 1.8 to 2.2 range. Vertical sellers are now at a median multiple of 2.7, representing 27% of all of those transactions. Horizontals at 73%, just about the same at 2.8. Infrastructure versus application software, the multiples remain very, very similar, very, very close. We normally see infrastructure exceed applications, and they too are very close. What you're seeing here is this is a great market if you've got the right technology and you've got customers and you've got revenue and you've got profitability, and you're a 10 or 20 or 30 or 50 million or $100 million privately held company. This is a great market. But look at this bottom sector where it says buyer less than 200 and buyer greater. Size matters here. Buyers less than 200 million paid a 1.6x trailing 12-month multiple on an equity basis, but buyers greater than 200 million paid 3.2x, double. They can afford the more valuable assets, and they're willing to pay more, and generally they have to pay more because those larger buyers are generally acquiring, not always, are generally acquiring VC-backed companies where there's a lot of preferred as well as common investors that need to be paid off, and those prices are generally higher. That said, we are seeing a record number of $1 and $2 and $4 million, two this week, dollar companies that are being acquired by Google, by Yahoo, by Microsoft, because they understand that synergy, which is the thing that's always driven software M&A, is not necessarily guaranteed. And what they're looking for are small management teams, brilliant people, and great little products that they can tuck in. Quick slide here on our color wheel. What you'll see here is, and I'm colorblind, but I can see most of this. What you'll see here is all of our sectors identified earlier in terms of their relative performance on an M&A deal volume basis. You'll see here security, CRM, the manufacturing, project, and asset management space. The financial services sector remains quite active. Healthcare. If we present this color wheel a year ago, you'd see very, very different size pie slices here. This market is constantly changing, and CRM is certainly a very good example of that. Security remains a very large piece of the pie here. Again, to my earlier point about be careful of the median valuations, not based only on the size of the buyer who comes to the table and the size of the seller that's acquired, which is more data on that slide that I did not have time to get to. Much has to do with the sector, and these sectors constantly shift. Although security has remained in the 1, 2, or 3 position for the last 2 or 3 years for very apparent reasons, many of these other, and so is storage and systems management, most of these other sectors have changed rather drastically. So the message of this slide is there continue to be huge M&A valuation disparities based upon software sector. If we compared these M&A median valuations by sector to the performance of the SEG software index companies in those particular subsectors, you would find in most cases very close correlation. So again, IT spending, downstream effect on revenue, downstream effect on M&A is the insight that we'd like you to take away from those 3 slides. Just quickly in the networking connectivity, area, IBM bought Micromuse for a 5.4x. Blip bought Visual Networks. F5 bought Swan Labs for 10.8x. In the security sector, Secure Computing bought CyberGuard for 4.5x. Symantec bought Cygate for 8.8x. Blue Coat bought Permeo for a whopping 16.9x. And storage, Brocade bought NewView for 8.3x. Iron Mountain bought LiveVault for 10x. You can see where some of that is coming from. But I guess I want to just go back there for a second. But you'll also see that at the bottom, Supply Chain, JDA bought Manugistics for 1.2. Keywell bought CSF for 0.7. So, again, be very sector conscious when you're doing software evaluation. In this slide, it's our prognostications for the remainder of the year. We're usually pretty good, and when we measure up in January of the following year, although we've missed it a few times, we are expecting, based on current trends, that we'll see the amount spent on software in Q3 and Q4 to substantially ramp. Q4 could see some mega deals, and we believe it probably will now see some mega deals that could push that 13.9 well above 15. So there's still a lot of money out there for the right company. A number of deals we expect to be at a record high, except for the crazy bubble days. These are very good deal volumes, historically speaking. And valuations, we believe, will end the year at a median for the year at about 2.7x. But again, beware, that can be very misleading. Let's talk briefly about SaaS, and then we're going to wrap up. This is a very different era than the ASP era. There are security issues. In the 1990s, when ASP came out, there were lots of issues and very, very high costs. Performance, customization, integration, and a lot of ASP tries failed and were pulled off the market. But times have really changed, and we wanted to look at what's driving the adoption of SaaS. Successful SaaS providers, and we track every one of them, and many of our clients are deploying on a 100% SaaS model. We'll be announcing a transaction about 3 or 4 days of another one in that arena that will have closed. They're deploying thin client, browser-based, flexible, functional, user-friendly apps that accommodate personalization and customization. That's the definition of a successful SaaS provider today. They're selling directly to a line or operating unit manager and circumventing the MIS department or CIO in many regards. They are actually penetrating the SME market, although that whether they're really able to do so remains to be seen. But it's a much more cost-effective model to be selling into the SME, the SMB market, and they're able to move much faster than perpetual license shrink-wrap companies. They're able to introduce new features instantly or much more quickly rather than waiting for the next release. And they also seem to have their finger on the pulse of the customers, which allows them to identify additional revenue-generating opportunities much quicker. So from a revenue standpoint, there's a potential for vastly accelerated top-line growth. From a profitability standpoint, the potential for double, and in many cases triple, the net income that many of these companies have demonstrated in prior years. We can talk about that model just a bit in the remaining minutes. They're signing a sustainable multi-year contracts rather than a one-time all-up-front license fee and an average of 20% maintenance and support revenue, which for a mature software company, perpetual license provider, we would expect to see a third of its revenue coming from maintenance and support after it's been around for 10 years, as opposed to 50, 60, 70% recurring revenue from many of these SaaS providers. And because they're not getting the upfront revenue, although many of them are charging initialization fees and then the recurring subscription fee, we're seeing some initial decline in revenue, but improved cash flow, and then the opportunity for significant recurring revenue as well as non-recurring revenue in addition. SaaS, it's believed that the world market will jump from $2.3 billion in 2003 to $8 billion in 2007, a 20% compounded annual growth rate. AMR research says that about 10% of all software today is sold as SaaS. Over the next 5 to 10 years, it'll grow to 25%. We don't agree with a lot of these industry analysts in their projections. We've been around a long time and then actually looked at the projections versus the actuals, but this is one what we do subscribe to. In terms of who are the key SaaS players, it's not just CRM anymore. You've got business intelligence. Cognos has got a major SaaS initiative. You've got HRIS, Workday, which is a David Duffield funded and run startup. He came from, as you know, from PeopleSoft. It's a 100% SaaS model. This is a really interesting slide we can't spend a lot of time on. But what you see here are high valuation. The street loves this stuff. Strong growth, so it's not without some foundation. But, man, I'm troubled, and a lot of people are troubled by the fact that these are still losing money. Look at that extreme right-hand column. Most of them are losing money. The belief is, given the revenue model, it'll shift pretty rapidly so that these will become profitable and quite profitable. M&A valuations in the SaaS arena, we've given you some examples here. They're pretty significant, those that are reported. Generally, you're going to see higher valuations. Certainly in the private software companies we're selling, we're seeing 30, 40% higher valuations of 100% pure SaaS play than we are in a shrink wrap play. It takes a lot more capital, though, to fund a SaaS company. They require $35 million in VC capital versus $20 million for a traditional shrink wrap company. There are GAAP revenue recognition issues. In a transaction we just closed in a 100% SaaS provider, they were recognizing some of their professional services revenue since it was complete and delivered and signed off all at once. But the GAAP rule on this, as SOFTRAX will certainly be able to help you with, really talks about having to do that ratably over the period of the license term if those professional services are really linked to and related to the license term. There's engineering issues in terms of integration, and there's legal issues in the SaaS model. It's not the easiest model to implement, but once implemented, we think it makes for a really compelling model. That about wraps up our presentation. It was a whirlwind tour of software M&A currently. I think we've left you with a lot of information. We would encourage you to go to our site, which is quoted on the second page, which is softwareequity.com, or you can go to segreports.com, which will get you there even faster, and download our quarterly reports. They're free. Our annual report, we have a modest fee for since it's about 80 pages and 1,000 hours of work, but the quarterly reports are free, and we would encourage you to download those. You'll also be getting, without having to go to our site, a one-page synopsis of our report through SOFTRAX. Thanks very much for your time, and we'd love to take some questions.
All right, Ken, thank you very much. And just to remind you, again, I've been reading questions throughout the presentation, and please click on the question box. It's not too late for more as we go through these. Ken, I don't know if you can navigate, or Steve could navigate to slide 13, which is that the pie chart.
Yep, we got it.
Okay, yeah, perfect. Thank you. A lot of questions on that. You said we could spend an hour on that, and we have a lot of questions, just clarifying questions to begin with. For one, any thoughts on the top right, any insight why the private companies are getting a higher multiple, especially when you look down below? It seems to conflict, some people thought, with the size of companies, thinking that private companies are typically smaller than public companies, yet once you get over 200 million, the multiple goes higher. So is that a conflict at all, and do you see, and you can provide some clarification in that, those two data points?
No, it's a good point, and the explanation there, one explanation, I'm going to have Alan pipe in as well, is that these private sellers showing that kind of multiple are highly strategic to the acquirer. And many of the public sellers showing that kind of multiple are generally consolidation plays and aggregations of companies that are not doing well and that are either being taken private and then bulked up, or that are simply being rolled into another company, but their valuation, their compounded annual growth rates are rather stagnant, their earnings are not good, and so it's a reflection of the particular companies in those categories.
Alan? And I'll add a little bit to that, just for one clarification. You had indicated, Bob, about the $200 million. That is for a buyer coming to the table. That's not for the seller. The other thing I would point out, and I understand where those questions are coming from, because your intuition would tell you that the larger companies are the public. There were a lot of troubled companies that were purchased in the second quarter and in the first half of 2006 that were public. We could talk to Infor DataStream, Oracle, which bought Portal Software, the Infor SSA deal for 1.8, Made to Manage buying Onyx for 1.6, JDA buying Manugistics for 1.2, Artemis being bought for 0.6. So there, like I indicated, a number of troubled companies that were being purchased that were public.
Okay. And still on this slide, could you give some examples of what a vertical seller is versus a horizontal? Just a little bit more detail on the description of those two categories.
Absolutely. A vertical software company is going to be manufacturing, healthcare, financial services, project management, education, insurance brokerage management, and underwriting software. I think we've worked in now 65 different verticals, multiple times within these verticals, so that's kind of the nature of a vertical. A horizontal company are going to be many of the companies that are identified under infrastructure software, talking about database and file management and development tools that cross all industry sectors, EAI, messaging, networking and connectivity, security, storage management, wireless, would all be examples of horizontals.
Okay, thank you. And I hope that clarifies for the people who asked that. And a related question is, you commented about the multiples of vertical sellers increasing recently. There were some questions about why, basically. What's happened in the tech market, or what's happened that makes that that has made that happen, and do you foresee that that trend continuing with regard to vertical sellers?
Well, we do, at least for the next year or so. And the reason for that is, if you looked at the websites of SAP, Oracle, Intuit, others 2 or 3 years ago, you couldn't find reference to the verticalization of their software. And many of these larger companies figured out that they needed to create industry-specific versions of their prime applications in order to be accepted within the vertical. And some of these are very huge, multi-billion-dollar verticals. And so today, if you go onto the websites of those companies, you're going to find the utility industry version of their software. Go on SAP's site and look on their industry-specific, right on their homepage. And so what these acquirers, these larger software companies, want to do is acquire the domain expertise of a vertical software company that will better leverage them into these target vertical markets where they can sell their ERP or horizontal app more effectively.
Okay, great. There were some questions about consideration, which you didn't spend time on, and I want to make sure that we do. What are any trends in consideration? Cash, stock, so forth.
You know, it shifts right along with the market. That's why we showed that first slide. We saw about a year ago no stock being used after, I guess it was in Q3 of 05, because NASDAQ took a real dip. What we're seeing in most of our deals, and most of the deals we're tracking, is a significant amount of cash. And certainly the private equity guys will actually fight you. They don't want to give you their stock. They'd much prefer to pay cash. And that's because they believe that the stock is, when it goes public again, is going to be very, very highly valued. So we see probably 80% of our transactions as all cash transactions, where we're insistent, and we believe in the upside as well. We're able to get a small amount of stock, and we're seeing increasingly earnouts when these big companies buy these smaller companies, they want to make sure that the founders stay around for at least a year or two, that even if it's a $15, $20 million company in comparison to the buyer's $3 billion or $20 billion in revenue, they don't want the seller's revenue to drop off a cliff. They want the principal shareholders, entrepreneurs to remain a bit engaged. So there's often now an earn-out component as well, but it's usually not more than 10 or 15% of total consideration.
Ken, you mentioned VCs and VC investments and where most of that money's going and so forth. And we had a few questions along those lines with respect to valuations. Do you have any thoughts on the valuations of expansion stage companies where you said a lot of the money's going? And another question had to do with even earlier stage valuations, a few $1 million, $3, $4, $5 million. So we had a few questions along those lines. So if you could comment generally on what's happening in that sector of the market.
VC valuations are up. It took them
up from what? That's the question.
It took them a time to get there, but VC valuations have definitely increased, and maybe that's because in order to launch these SaaS models, more money is necessary. Entrepreneurs are just not willing to give away 80% of their or 60% of their company on a first round where they know multiple rounds remain. And as a result, because when the VCs do get excited, I still, after all of these years, scratch my head about when they do and why they do. But when they do get excited, we're seeing that the valuations are clearly higher than they were a year ago.
Okay. The private equity buyers.
And Bob, sorry.
I'm sorry.
I think that's one of the reasons why we have so many VCs subscribing to our reports. They're tracking this stuff carefully because they know the entrepreneurs are also tracking this stuff carefully, and they're armed. They're both armed with better data getting into the room these days. That's sector specific and that sort of thing.
Yeah, and there's certainly many on the webcast as well, which they're always welcome. I wanted to ask about the private. I didn't want to. Some people want to ask about private equity buyers. And if you're a software company and you're looking for an exit strategy, what kind of profile would make some sense? Throwing the sun guards out and things like that. But where most of those deals getting done? You have to be over $50 million. Can you give some idea to a software company about whether a private equity play is even possible given their situation?
Okay, Bob, this is Alan Cinzori. I'm going to go ahead and handle this question.
Sure.
Absolutely, there is the opportunity. I think when you look at what is the profile of a typical private equity target company, what you got to look at is you're looking for companies that, in today's market, they can put debt on that business. They're doing leverage buyouts, which is unprecedented for the software industry. We had seen that for years in manufacturing, but because there has historically been no collateral assets in the software industry, the debt markets stayed away. Well, now with these businesses becoming more mature and these recurring revenue streams acting as collateral, it is now exciting for the private equity investors and the debt investors to invest in mature businesses. So, to answer your question, the profile, now it depends. If we're targeting tier 1 private equity firms, these guys want to put $100 million of equity into the business. They want to put another, let's say $100 million of debt onto that. So we're talking about a $200 million purchase price. And that would probably equate to an EBITDA multiple of about 10 times. So a company that's generating $20 million in EBITDA. So that would maybe equate to a $100 million revenue business, $125 million revenue. But that's the tier 1 guys. There are tier 2 guys and tier 3 private equity firms out there that are looking for smaller companies that are very profitable, that are maybe generating somewhere in the neighborhood of 40%, 20 to 40% in EBITDA margins, that have recurring revenue that's probably north of 40%. That would be on maintenance and support, or if they've got some form of a subscription model, that's something that's absolutely necessary, and it makes them feel as though they can cover the bet that they've made on those businesses.
So the bottom line is that we currently, and have for some time, been representing one of the top 3 private equity firms, buyout firms in the world, as their investment bankers in the software sector. They're looking, as Alan said, for these very large platform acquisitions that they can take private or large private companies that they can handle in the way that Alan described. But many of these private equity firms, already having secured that platform company, are looking for strategic tuck-ins, and that was the example we gave in the two Deltek transactions we closed in the last couple of months. So that's how you've got to figure out what your size is and whether you're a platform or a tuck-in, and then whether you've got the numbers to back it up in terms of attracting a private equity firm.
There's some questions about balancing growth and versus profitability. Let's say for private companies, maybe expansion stage private companies. Any advice on what the market's paying for in terms of growth versus profitability?
That used to be such an easy question, and it shifted. So we kept tracking it. This year it's profitability. Next year in 2003 it was profitability. 2004 it became growth. In this year, except for a couple of sectors like SaaS, where you're seeing good public companies with relatively high valuations that are losing money, the answer is that to be attractive to an acquirer, you need to be profitable, you need to be state-of-the-art, and you need to be growing. And that is very difficult for an undercapitalized $5, $10, $20 million software company. And you need to have a SaaS model either deployed, getting most of your revenue, or at least deployed. And that's why we say the market is not just throwing money at companies. You've got to have the right revenue, profitability, sector, et cetera.
On the SaaS issue, have you any advice or insight for public companies who are transitioning to a SaaS model and how to maneuver that with respect to messaging and with regard to revenue and EBITDA impacts, because they're significant, certainly?
Yes, we do, but we'd never cover it now.
We'll deal with that privately then.
It needs to be done carefully. You really need to figure out your revenue model. You really need to figure out your migration from your perpetual to your new version SaaS. You really need to understand your SaaS subscription pricing. You really need to understand the impact on the upfront revenue that you're used to getting and how that's going to diminish your R&D capability, investment capabilities. When the subscription revenue will cross over the shrink wrap revenue and how long you're going to have to tighten your belt. There's just so much to think about. Certainly don't have time for that now, but maybe the subject of another webinar someday.
Okay. There was some discussion or questions about the London markets and the AIM market, and will your research be including that in the future? And generally, what's your opinion of those markets?
We have currently, I think, 4 or 5 clients in England, and we track the London market. And Europe has been relatively active, although there have not been very many acquisitions of North American companies, relatively speaking, by European companies. So we haven't as yet found the need to track the London Stock Exchange, the Bourse. We have clients on the Bourse, so probably nothing in the near term.
Okay. Well, we're up against the clock, and we've done this for an hour. So, Ken and Al, thank you very much for your participation. I'd like to thank our attendees for their participation. They're great questions. I'm sorry we couldn't get to them all, as always. I would like to remind you again that your screen will be directed now to a URL, which is our customer feedback portion of the program, and we'd like that feedback. That'll get you copies of the slides. That'll get you the executive summary of Software Equity Group's report, all of which are very valuable. There was a lot on the slides, and certainly they're great to have. So we thank you very much, and also please stay tuned and continue to visit SOFTRAX.com and RevenueRecognition.com for future events and webinars such as this. Again, Ken and Alan, thank you very much, and thank you for all for attending. Goodbye.